Hello traders community. Today we are going to discuss about fair value gaps. Fair value gaps are a very useful concept in price action trading, as they provide traders with information about where a lot of orders were injected, creating this inefficiency in the market. This inefficiency can become a magnet for price in the future to resolve this inefficiency, as there are many resting orders. A trader can use this information to target a fair value gap or to look for a potential entry for a long or short, making it a good point of interest. So what exactly is an imbalance? Imbalances, also known as fair value gaps or market gaps or inefficiencies, occur when a market exchange receives too many of one kind of orders, buy or sell, and don't receive enough for the other. For every seller, there must be a buyer and vice versa. When market makers execute too heavily in one direction, an imbalance is created. How to identify an imbalance? So basically, an imbalance is formed when the body of a candlestick has not been violated by the previous and following wicks. Imbalances are created by three-candle formation pattern, where a gap, candle 2, is made between the wicks of candle 1 and 3. So let's move on now to a chart example to clear things for you. In this chart example, price dropped down impulsively and left this imbalance. However, price didn't leave a fair value gap in the second candle because, as we can see here, the wick of the previous candle was covering the body of the second one. In this fourth candle, price left this small fair value gap. So why do we identify an imbalance? Imbalances show us where there were unequal opportunity for either buyers or sellers to exchange at a certain market price. Since the market always seeks balance and efficiency, we know price must travel back to those inefficient price levels to provide sellers a chance to buy or buyers a chance to sell. Once the imbalance gap is closed, price becomes efficient and will likely continue in the trend direction. How price acts towards imbalances? Once you identify an imbalance, market makers are willing to push the price back to these inefficient areas where price hasn't traded fairly. It's a form of magnet of price. You'll expect that imbalances will be filled in the future. So let's see some chart examples so that you understand better the concept. Here we are in front of a bullish bias. Price broke the structure and formed two fair value gaps. So you can notice that price after that came back to fill these fair value gaps exactly. The imbalance is a concept that may appear simple and easy at first glance. However, it cannot be taken alone as an entry trigger, whether in a long or short position. This concept must align with other elements to get more precision entries. So let's move on now to the imbalances and market structure. Entries within a fair value gap must be in confluence with the current structure of the market. When market structure holds bullish, watch entries on the long side by waiting price to fill the fair value gap. When market structure holds bearish, watch entries on the short side by waiting for price to fill the fair value gap. We'll see now some examples from the chart about market structure and imbalances. We are using 30-minute Nasdaq chart. We have a bullish trend. Price is making each time higher highs, right? First, we identify the imbalances and wait for the retracement to happen and the fair value gap to be filled before taking a long entry. The stop loss must be set below this fair value gap. Now we are using 1 hour Nasdaq chart. The trend is bearish. price is making each time lower lows. We can see clearly this fair value gap at the level of this red candle. You can notice that price, after breaking the previous swing low, retraced back to fill the fair value gap. Once the fair value gap has been filled, we take a short entry with the stop loss just above the previous swing high. The trend is your friend. Always remember that. Don't even rely on fair value gaps uniquely. We suppose that you open the chart and you spot these two fair value gaps. So probably you'll think about taking a short position here and setting your stop loss just above the previous swing high, right? So you were wrong because you are trading against the market structure. When you zoom out, you'll see clearly this bullish trend. Draw on liquidity. Liquidity is like a magnet for price. Market makers are always seeking for buy-side and sell-side liquidity before moving in a bullish or a bearish direction. Therefore, avoid going long in a fair value gap before sell-side liquidity is run, and avoid going short before buy-side liquidity is run. So let's see some chart examples. We are using in this example 15-minute Nasdaq chart. We have a support line created on purpose by market makers to trap retail traders. Price will always seek for sell-side liquidity and retrace back to fill the fair value gap before continuing higher. As smart money traders, we wait for price to fill this last fair value gap before taking this long entry. In this second example, we can notice that price is forming equal lows at this level, which means that sell-side liquidity has been left. So even if the imbalance has been filled completely, we should not take a long position because market makers will make sure to drop price down to take the sell-side liquidity first. In this case, we can wait for price to trade back to this bearish fair value gap before taking our short entry. In this third example, we are using 5-minute Nasdaq chart. There is buy-side liquidity resting above these equal highs. Market makers will move price higher to take liquidity before dropping down. As a smart money trader, we won't take a short position using fair value gaps until the buy-side liquidity has been grabbed. So after this bearish break of structure, we can take a short position once the fair value gap is filled. So let's move on now to the imbalances in order blocks. When a fair value gap is close to an order block, the setup is much stronger. In a bullish market structure, when price retraces back to fill the imbalance and reaches the order block, you can set a long position with a stop loss just below the bullish order block and vice versa for a bearish trend. To have a clear idea about all this, we'll move to the chart to see some examples. In this example, we have a bullish trend. We can notice this bullish order block that leads to this break of structure, right? Above this order block, there is a fair value gap. So we wait for the retracement to happen, the imbalance to be filled, and price to reach the order block before taking a long entry.